the stock market going up is not a sign of a strong economy. It's actually the reverse. The reason the stock market is going up is because investors expect a recession, and they expect the Fed to cut rates at some point due to that recession. And that's why the stock market is going up.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
Gold now back below $2,000 an ounce. In fact, it's down to $1,960 an ounce, which is still a much higher price than it was when the year began, but we were trading north of 2,000, and we've had a pullback, including a $25 pullback today. I think at the lows, gold was off a little over $30. The catalyst for that sell-off was more tough talk from, I think, 3 different Fed members about how June is going to have another rate hike. That the idea that they could take a pause in June and skip a meeting doesn't seem to fit given how bad inflation is. That inflation is still a problem, it's still persistent, and so we need to continue hiking. And so that caused the sell-off in gold, a rally in the dollar, and also a sell-off in the bond market, particularly in the shorter end of the curve. So the yield curve steepened on this tougher talk that the Fed is going to be hiking more. And in fact, if they hike in June, which it seems like they're going to do because they've obviously just laid the foundation for doing that, and at the end of the day, the stock market went up. In fact, the NASDAQ made a new 52-week high today. And the Dow, which was down most of the day, still managed to be up over 100 points. But again, the NASDAQ was the star, especially these tech stocks leading the way up. NVIDIA up 5.2%. That's a new 52-week high. Microsoft up 1.8%. In fact, Microsoft and NVIDIA are almost back at their 2021 all-time record highs. But you had other, Google up 2%. I made a note, Meta was up 2%. Netflix up 9%. I'm not even sure what the news was on Netflix, but they were up 9% today. These are big moves. A lot of it has to do with AI. I think that's the new theme now because you have stocks that are already implementing AI to cut their costs. They're going up. But then I think the stocks that are going to be the companies that are going to help other companies implement AI to cut their costs, right? Anybody that's connected already to AI, that's kind of the new .com. And so you're starting to see a movement, or have been for a while, in a lot of these stocks. So the stock market is shrugging off a tougher Fed. But gold got hit, bonds got hit, the dollar got a boost from this. But if the Fed does this, the Fed funds rate will be 5.25% to 5.5%. That will be the new range. Now, this means that rates will exceed the peak of the prior cycle, which was the last rate hike in 2006. I think it was June of 2006. The Fed hiked to 5.25%. At that time, they didn't have a range like they do now. I'm not really sure when they decided to go from a fixed number to a range. I think that was somewhere when they were at the zero bound, because they were never officially just zero. It was between 0 and 25 basis points is where they were. And so then they just kind of kept those ranges when they started hiking. But the number in June of 2006 was 5.25%, and it stayed at 5.25% until sometime in 2007 when the Fed cut rates for the first time, right, on the way to 0%. But if this hike comes in June, a few weeks from now, that will put us at 5.25%, 5.5%. So we will be above the rate hike level, the interest rate level that precipitated the 2008 financial crisis and Great Recession. Except the difference is today we have so much more debt than we did back then. Everybody has a lot more debt. The government, corporations, individuals. So that level of interest rate will do far more damage today than it did in 2007. And we know how much damage it did then because we had the financial crisis of 2008. So the financial crisis that has already begun in 2023 is going to be much worse than the one that we had in in 2008. And in fact, just even looking at debt, I was looking at some of these numbers. So household debt is now above 17 trillion. This is at the end of Q1. This is the first time that households have ever had this much debt. But here's the even more disturbing part about it is the credit card debt, because credit card debt in the quarter was flat for the first quarter. But the first quarter of a year is typically the quarter where credit card debt goes down. Why? Well, because people spend a lot of money in December because, the holidays, Christmas, Hanukkah. So people are buying gifts and spending a lot of money on their credit cards in December. And so what generally happens in January, February is they pay down those balances. So it's a quarter where you typically see credit card debt going down. But in the first quarter of this year, credit card debt didn't go down at all. So Americans are using their credit cards as a lifeline. That's how they're dealing with higher prices. They're charging stuff. And in fact, if you just look at the month of March, in March, debt was up, credit card debt, just credit cards, not, all the other debt that's going up. $17.6 billion in March alone. That's in 1 month. And that represents a 17.3% year-over-year increase in the amount of credit card debt that households are carrying. The interest rates on that credit card debt is 20% on all that money. Now, this also shows you that the Fed is making no progress on inflation because the consumer keeps spending. Where are they getting the money? They're borrowing it. Credit continues to expand. That's part of the inflationary dynamic. Inflation is about an expansion of the money supply, which includes credit, because this credit is being spent. So consumers are not cutting back on their spending because of higher prices. They're not even cutting back on their spending because of higher interest rates. They just keep on spending. So prices are going to keep on rising. And this next quarter point rate hike isn't going to be any more effective than the previous rate hikes, which means they're going to have to do it again. They're going to have to go from 5.25% to 5.5% to 5.5%, 5.75%, 6%, 7%, 8%. They're going to have to keep hiking rates. But no matter how much they hike it, it's not going to matter. That's what the markets still don't understand. Gold, again, sold off on this tougher Fed. Oh, the Fed's going to fight harder to beat inflation. No, the Fed is losing its fight with inflation. That's why it's going to try harder, but it's going to be ineffective. If they couldn't beat inflation with 5, they're not going to beat it with 5.25. And again, all of these rate hikes are price hikes. They're all going to be built in to the into the cost structure, the price structure of all of these businesses that are having to deal with rising prices. And we got the leading economic indicators that came out today. I've been talking a lot about the LEI. It was down again, not as much as the prior month, but it was down for the 13th consecutive month. Now, the last time we had a losing streak that bad was 2007 to 2008. June, I wrote it down, June 2007 through April 2008. That was like the financial crisis, the collapse of Lehman Brothers. That's where you have to go to find a streak longer. And it was actually 22 months of negative LEI. Now, we're only at 13 months now, but I think we're going to break that record. And the most ironic part about it is the biggest positive indicator in the LEI, and without this it would have been lower, is the stock market, because the stock market is going up. But I've said this before, the stock market going up is not a sign of a strong economy. It's actually the reverse. The reason the stock market is going up is because investors expect a recession, and they expect the Fed to cut rates at some point due to that recession. And that's why the stock market is going up, although, there's also the AI stuff. But, the flip side in the short run of companies using AI to lower their costs, the reason that AI lowers your costs is because you lay off your workers. That's how you save money. You have AI do the work instead of employees. So in the short run, that's going to fuel the unemployment. And again, maybe the market's like that because they think, oh, the Fed's going to see this unemployment and they're going to have to reverse course. But again, the reason that that's not going to be good, I don't think, for the markets is because inflation is still going to be a problem, and that problem is going to get even more out of hand as the Fed starts easing to try to prop up the collapsing economy. Now, the other issue with credit has to do with the federal government. And again, the national debt ceiling debate is gaining momentum. And another reason, too, for this, and part of the evidence of the weakness in the economy, is in the month of April, the government's tax revenues were 43% lower than they were in the prior year. So despite the inflation, despite the fact that prices are going up and spending is going up, the government's revenues are going down. In fact, this April, the government collected less tax revenue than it did in April of 2017 or April of 2018, right? Well before COVID. April is normally the month where the government gets a lot of money because that's tax month. Everybody pays their taxes April 15th and sends in their checks. So it's one of the few months where the government runs a surplus. And of course, those surpluses are then offset by all the months it runs a deficit. Well, this April, the surplus was much smaller than normal. So there's less there to offset the deficits that are going to occur in all of the other months. The question is, why is tax receipts going down? Well, because the economy is weakening. And so there's not as much revenue being paid into the government, but the government is spending even more. So the deficits are exploding well north of $2 trillion a year, which means the national debt is going to keep spiraling out of control if we raise the debt ceiling, which of course everybody wants to do. And the most ridiculous thing now about, Biden, he was on television talking about it, or the Democrats, they're basically saying that if we don't raise the debt ceiling, all hell's going to break loose. I mean, all of our prosperity is going to go away. It's going to be complete economic mayhem. Everybody is going to suffer if we don't raise the debt ceiling. Now, what does raising the debt ceiling accomplish? Well, it allows the government to take on more debt. As if $31.5 trillion wasn't enough. If we raise the debt ceiling, we can go deeper into debt. Well, why is that a necessary ingredient for our continued prosperity? According to the White House and pretty much every Democrat on television, we owe our prosperity to the national debt. That's the ticket to the good life, that we need a government to keep on running up more debt. That's the secret, right? That's the secret sauce to our economic success. It's government debt. And without the government running up more debt, we're all doomed. That's what they want us to believe. Because if they don't raise the debt ceiling, what happens? See, they're saying, well, that means we default on our treasuries. That's not what it means. If they choose to default on our treasuries, that's what it means. All it means is we have to balance the budget, right? There are a lot of people who run for office and they say, I'm in favor of a balanced budget amendment. When I ran for office, I said, we don't need a balanced budget amendment. Just don't raise the debt ceiling. And that automatically requires you to balance the budget. If you can't take on more debt, well, then you have no choice but to balance the budget. And that's what would happen. If we don't raise the debt ceiling, then the government has to balance the budget. So what the Democrats are saying is that a balanced budget would destroy the economy. If we had to balance our budget, everything would collapse. If we had a fiscally responsible government that lived within its means, the whole country would implode. Now, what would implode is the bubble, right? The fantasy would collapse because we couldn't kick the can down the road anymore. That's what not raising the debt ceiling is. It means the buck stops here. No more can kicking. That's the reality that the politicians want to avoid. They want to avoid facing the music, right? So that's why they want to raise the debt ceiling, not because it's going to ensure our prosperity. It's just going to ensure our demise happens later. But that collapse, when it happens later, will be worse. You see, the more they succeed in postponing the inevitable, the worse the inevitable gets. And we know it's inevitable because what are they saying? If we don't raise the debt ceiling, we can't pay our bills. Well, that means we're broke. If we can't pay our bills unless we go deeper into debt, then we are broke right now, right? Because in theory, we have plenty of revenue to pay our bills, right? Because interest on the national debt isn't even 10% of the current federal spending. So the government can do it. They just have to cut spending someplace or raise taxes, but they refuse to do that. And so they want to raise the debt ceiling.